Today's topic is due diligence. All right, that's just the business plan. Then we have the general information that you got to ask for, right? So you got the pitch deck and the executive summary and a financial model. They should be giving you an org chart. These are things you can just make a list. You can find checklists of this all over the internet. But you should be asking, give me an org chart. How many people are there? What do they do? What are their titles? How are they connected? Give me the resumes of all the management team, right? Show me who's in charge of this company. Capitalization table is the list of everyone who owns stock in this company and how many shares they own and what percentage that is, and anything else like stock options and warrants that are lying out there. Stock options, stock option grants, warrants, anything else that has changed the ownership of this company. And then you want contact information for all the managers, all the directors, all the shareholders, for the lawyer, for the accountants, for the consultants, and a few customers. So when you're doing due diligence in a big deal, you want to especially talk to the customers. You want to hear from them that they like this product and want to buy more, that they love this product and want to tell their friends. And if they're not willing, if the company's not willing to share that, that's a red flag. And if the customers are not willing to just tell you this is awesome, that's a pretty strong reason to say no. All right, back to that market opportunity. So they should be giving you this number that's called total addressable market. That is all the potential customers out there multiplied by the price that they're charging. And that should be a big enough number that you say, great, if we grabbed some of that market, we'll be fine. That should be big enough in the world of impact that a bunch of companies can show up. We don't need to do the winner take all thing here. A bunch of companies can show up and each can take 20% of the market or 15% of the market. And that's sufficiently large. And if it's not, if it's some really important problem to you and the total addressable market is tiny, let's say $1 million a year, you might think twice about making an investment. That might be something you want to pull out your philanthropic dollars for. There's a bunch of ways to describe the smaller bit of that, which is the total reachable market. You know, how much market will this company actually get in 3 or 4 or 5 years, given the money they're asking for? And again, you can build that up from the bottom up. The way I usually teach people how to do that is just start with your sales team. Like, how many salespeople do you think you'll have in 3 years? How many potential customers can they talk to at once? How long does your sales cycle take? And how many of those conversations are going to wind up as closed sales? You do that math for a year, and that's the size of your business. There's no way for you to get bigger than that unless you open up another channel, unless you have someone else selling for you. And this is why online businesses get so much more venture capital, because they can do sales without involving people. They can put up a website and sell off the website with no human being. And then it's just a matter of throwing in enough money on the marketing side so that those marketing dollars turn into sales. And then the question comes down to, okay, for every dollar you put in the marketing channel, how much came out of sales in terms of profits? Was it more than $1 of profits? And if not, then you're doing something wrong. All right, market opportunity includes segments. So there's usually a whole bunch of people who have this problem, a whole bunch of different types of people in organizations that have the problem that are being solved. And no startup can do all of those segments at once. So it's ideal if they can list out what those segments are and then tell you which one they're targeting first or which ones they're targeting first. And why did they pick those? Why are those the right ones? And there needs to be a story behind that. And then I brought up before, do the customers even know they have this problem? So if they do know they have the problem, and again, you can talk to the customers and ask them, how were you solving this before? Usually the answer for startups is not that you replaced an existing competitive product. Usually the answer is that they were solving it using something that they built themselves. They were using an internal process that was based on a spreadsheet or email or Post-it notes or calling people on the phone. And now they found this much better solution that the startup is providing, and that's why they're so happy. Sometimes it just wasn't a high enough priority given the price to solve the problem, and the startup has brought something that's affordable to solve the problem. And sometimes they just don't even know they have it, in which case the question comes down to, how much is it going to cost to teach them that they have this problem, that to make them aware of that, and that can be a problem. My second startup was like that. We couldn't even figure out how to describe what we were doing because nobody out there could say what the problem was that we were solving for. That was an issue. All right, and then in terms of competition, who's out there, who's competing, what are their strengths and weaknesses, what's their price? So you got to ask the company that you're talking to, who's your competition for real? Who's your competition? You go off and Google those companies. You figure out what they're doing. You figure out why this startup is possibly doing better job. You got to ask the startup, like, what's your competitive advantage? And you have to check that out and do a little bit of analysis yourself. Just don't believe them.